Shopify, another e-commerce company that's been beaten down by a considerable amount. Today, folks, we're going to do an analysis on Shopify. We're going to run the numbers through the stock research app built by yours truly. Now, I covered Amazon last time, or not last time, but a couple of episodes ago. And same thing is happening with Shopify. We're seeing a massive decline in this stock's price. As you can see, we hit highs of 176 and a low now of $27. Now, this is huge. This is a major drop, folks. Now, when I see major drops like this, I get concerned, but I also get excited because when a company's stock price drops, it becomes less volatile, one, and two, a little bit more interesting because huge drop-offs usually come with some speculation, some fear, and us value investors, we want to capitalize on that fear. And with Shopify is no different. In the app here, we are ranking this company a 7 out of 10. And if you are new here, what this software does that I built, it takes a look at the company's cash flow statements, the income statements, as well as the balance sheets, and grades it out of 10. And based off that score, we get a pretty good idea of the overall strength of this business. So with Shopify, 7 out of 10 is a pretty decent score. We're losing points in three categories. One being the PE ratio being astronomically high, being at 223.45 over the last 5 years. That's like too big, too large. We want companies underneath 22.5, and as well as our ROE average sitting at 3.99%, where we want to see this number 15% or over, and our ROIC average being negative 2.05%. Not great. That is not good, folks. We want to see this number 10% or higher. So what that showcases to me is that it is a highly priced company with a high PE ratio. The return on equity obviously is garbage, and they don't know how to make a decent return on their money, with the return on invested capital average being so low. However, it's not always doom and gloom news for Shopify, because take a look at everything that they are doing right. They have a phenomenal current ratio. It's 11.17. They have enough assets to cover their liabilities. That's what that number means. They have a huge amount of EPS growth, as we can see right here, 143% over the last 5 years. Extremely low debt to equity, sitting at 10%, where we want to see this number 50% or lower. As well as they are not diluting you. They're actually buying back shares. It's a small percentage nonetheless, but 0.77% of shares have been bought over the last 5 years. Not bad. The only discretion, though, the only issue that I have with that is if they're buying overpriced shares. Now, and it's my thesis is that's exactly what happened, due to how high the PE ratio is on average and at how high the stock price actually was. So that is whatever, but it's good to know that that's actually happening. Now the stock price may be in that value territory. We'll find out. The net income is up, the free cash flow is up, and the revenue growth is up. This is a company that is growing. However, they're just getting docked in a few categories. Now that's normal. So it's something you have to either deal with and live with or stay away from. So when I see a company growing their free cash flow, the net income, and their revenue, and I see the price drop down, this is where things get interesting, because now, with that being said, we can actually price out what this company should be and find the intrinsic value from the price analysis section. We can do a 10-year analysis on this business. We're going to put some assumptions in, and we can find out what this company should be priced at. But here's the thing. In recent news, they've actually, before we jump into that last little bit, you have a great fundamental, what's the word I'm looking for? You have a great product in the e-commerce space. Everybody that makes an e-commerce website, Shopify is pretty much front and center if you're making an online store. So why limit yourself to just an online presence when you can secure the brick and mortar as well as some sort of back end? Now, maybe their whole thing is people are going to go away from brick and mortar and then they're going to go online, but that is hardly ever the truth. Yes, the pandemic slowed things down, and a lot of people will turn to online shopping to, supplement them not being able to get out of the house and not go to brick and mortar stores. But it turns out, folks, people like and miss shopping at just brick and mortar stores. So they are missing out on a huge market opportunity if they don't capitalize on this. That being said, let's jump into the price analysis section. I will fill out these lovely boxes and we'll talk about it in just a quick second. If you're enjoying the video so far, hit that like button, hit the subscribe button. It means a lot to me, it means a lot to the channel, getting this software out to you as soon as I possibly can. Let's take a look at this. I'm going to click calculate. The software is going to run through all my lovely numbers and we'll discuss what I did. But here's what I briefly did, folks. If you're new to the channel, I like to try to stay as conservative as possible. So I did conservative revenue growth numbers, but I kept profit margins pretty much in a sporadic range. I kept the aggressive category slightly over our 5-year average in that 1-year territory, being at 15, moderate being 10, and conservative being 5, along with our free cash flow being 4, 4.5, and 5, just to echo what we've done in the 5 years. I kept a moderate PE ratio, and price to free cash flow, similar idea. 598 is astronomically high for a price to free cash flow. We want to see numbers below 20, and this is speculation territory where I went 14, 16, and 18, where even though our PE ratio is negative 18. And that being said, folks, take a look at this. With what I put down here on the board, our average calculation comes out to be $28.86, pretty much fair value. If you buy the company today, based off of what I've put in here, on average, you pay $28 in the moderate category, and you can somewhat expect a 13% return over the next 10 years. Now, you know what? This is echoing a lot of the 5-year numbers here. Our DCF isn't obviously in that range though, but $20 is not too far off from 27. And so 28 is pretty much that happy medium. So if you think about it like this, folks, even if it grows, let's say it beats my revenue growth numbers and it grows in the 64 or 57 to 64% category year over year, you're still getting a decent buy, right? 25% revenue growth with a profit margin being at 10% and free cash flow margin sitting at 4.5% with a decent price of free cash flow and a decent PE ratio. I would argue it's around there. Now, if you want additional margin safety, I would say it's probably could be here. And it's conservative, between the conservative and moderate average. That's where I usually like to look for companies, anything that kind of falls between these categories. So maybe sub 20 might be your opportunity to buy if you want that additional margin safety. Now, I could up the revenue growth. I could go 30, 35, and I can go 37, increase that by a little bit. Now, that'll change things. We'll calculate that. But I truly believe it might be, look at that. So look, 35, obviously super generous here, $61 on average, and 30, 24, it's close. It's pretty close. I do think that 20, around the 20-ish mark makes the most amount of sense, but you have to figure that one out for yourself. This is the start of a deeper process. Now, my software here, as I said, has access to all stocks on the New York Stock Exchange, any kind of American stocks, as well as European markets, and Canadian markets. So for my Canadian friends out there, we got you covered as well. As well as the app also has the latest news that covers each company's stock price, or sorry, ticker. So anything that you want to take a look at, it's all here. It's a one-stop shop. But folks, write down in the comment section below what you think about this analysis. So currently, I think Shopify has a great idea and it's a phenomenal platform. However, it's just slightly overpriced. However, there's a lot of little things. There's a few little things that has to be corrected. But from a starting point, it may almost be in the right price. And this is the start of a deeper research. But almost at fair value, guys. That's what my analysis is telling me. What do you guys think? Write it down below, and I will see you in the next video.